It's Monday, 1 p.m. in beautiful Bangkok. My name's Andrew Stotz, and I'm with you for this Monday coffee break. I already had my lunch, took a little nap, rested a bit. Now I'm sipping some delicious Coffee Works coffee. Do you have a cup of coffee or a cup of tea or a cup of water? What do you have? I want to say hello to everyone. I see already some people putting in some messages, and I saw Gal says good afternoon, and TT says good afternoon, and John Andrew. It's good to see everybody. Today we'll be reviewing the performance of the all-weather strategies, and hopefully I can take some questions from you. Gal said, I had a cup of mocha this morning. Sounds yummy. I'm a total espresso guy. I don't know. I just drink espressos all the time. All right. What about other people? What are you guys drinking? What are you eating? Have you had your lunch? John Pence says, hi. Good to see you. Natapon says, Sawadee Kap. Kun Andrew. And we're Boone says, lunchtime. Krap. Yep. Happy Dragon Boat today. Grid says, happy Dragon Boat Day. Is today Dragon Boat Day where they go the dragon boats down the river? That's pretty cool. I didn't realize that, actually. I live in a shell sometimes. Well, I hope everybody had a great weekend and things have been going well in your life. And I just want to welcome you here. We've got about 107 people on right now, and hopefully that will grow. And as it does, make sure to ask questions. I love questions, and particularly tough questions are ones that make me think. Super Gone, good to see you. I hope all is well. And I just want to tell everybody that we're going to get started now. And remember to ask questions. You can start asking questions now. Benz, good to see you. All right. I'm going to share my screen and show you. There you go. The all-weather strategies, and I'm going to go through some of this. I'll stop after a little bit and then take questions, so feel free to ask questions. This is a review of the May performance, and just type your questions in the chat. I love to answer them. Type them now. All right, so we're going to have performance review of May, some special research where we've been looking into gold. Well, our allocations are global, long-term, and diversified. That's the key to what we're bringing Phenomena and bringing you ultimately. But I always like to start off by remembering why we are here. We're here to build wealth over the long term. And I see 6 pillars of investing that matter. The first one is invest in stocks. Stocks have returned much more than bonds and gold over the long run. And owning a piece of a company means you get a portion of what the management team creates, which to me is like the coolest thing. And you didn't even work in the company and you got a piece of that, whether that's a dividend or other things. Number 2, reduce risk. Avoid overexposure to any single asset by spreading your portfolio across various companies, sectors, countries, and asset classes. We do a lot of work on trying to understand how to further reduce risk. And contribute regularly. Reduce stress by applying dollar cost averaging, which basically means consistently investing a fixed amount over time. And this takes advantage of volatility and likely lowers your costs and enhances your long-term gains. And stay invested. Think long-term, be patient. The benefits of compounding happens over decades. And maintain discipline. Follow your investment plan to avoid actions based on emotions. And finally, number 6, keep learning. Deepen your understanding of investing and stay informed about market dynamics and refine your strategies by learning from successes and failures. And you're going to have a lot of them. I've had a lot over the years, and we're going to make them with this strategy too. The difference is with this strategy, I'm going to talk to you about it and share what we're learning as we go through. Now, we create our strategies for many decades, but not even a decade is really long term. This is me when I was a baby boy, And this is me when I came to Thailand, and this is going to be me when I'm 100. So our aim is to create strategies that perform over many decades. I outline most of this in my book, How to Start Building Your Wealth, Investing in the Stock Market. So let's get into what we're doing. Our goal is to deliver steady returns over the long run. And here you can see our 3 core strategies. So the first strategy, the red line, is all-weather strategy. The blue line is alpha focus, and the green line is inflation guard. And we can see the performance over time. Now, obviously, we can see that alpha all-weather strategy is the highest, but that's because we've been going for the longest, since February 19th, which gave a lot of time to compound. So AWS launched in February of 2019 and targets 6% per annum return. Alpha Focus was launched in October 2021, and we're targeting 8%. And Inflation Guard launched in July of 2022, and we target 4% per annum. These are our goals of what we're trying to do with these strategies. And I want to just go back to one of the goals with the green line, the inflation guard, is to try to reduce the volatility. You can see a lot of volatility here and a lot of volatility in the blue line, but the green line has much, much less volatility, and that's because we have a heavier weight in, let's say, bonds and the like, rather than only stocks. Now, from when we started all-weather inflation guard in July of 2022, the strategies are performing almost as expected. In fact, what we can see is all-weather strategy actually has the highest return. It's done very well. Inflation guard has had the lowest, but also the lowest volatility. And then alpha focus has been catching up over time. And all strategies had lower volatility than world equity. Again, you can see that we're trying to cut out, by mixing asset classes, we're trying to cut out that volatility, but it also means that we're going to cut out the upside sometimes. You're not going to get all the upside. So let's, before I continue, let me just go back to talk to you for a second. Hold on one moment. Let's remove that. So let me just go through any questions that we've got so far, and feel free to add any questions. We haven't gotten into performance yet, but before we do that, let me just get a nice sip of espresso. All right, so let's see some of the questions. Will you consider ASEAN as a sub-region for allocation? Vietnam, Indonesia, and Vietnam seems growing, while Singapore will benefit from ASEAN growth. We do actually have an ASEAN stock portfolio, and we haven't brought it to the Phenomena platform yet because it's only based in the past on mutual funds. Hopefully, over time, Phenomena will also have stock platform. We can do it other places. But what I can tell you, which may be a little bit disappointing, Kun Supakon, is that we won't have Vietnam in there just because it's not an emerging market. It's a frontier market. And generally, that means a lot less information for us. So from a stock picker's perspective, I think Vietnam is interesting. But from an asset allocator, it's a little bit harder for me to do Vietnam. So yes, I do see ASEAN as a sub-region. But right now, I haven't been allocating to it. John Pence says, how do you think about gold? Buy on the dip or wait and see? Well, this is the problem all the time with all of our stock positions and bonds and gold, is that, you know, it's never perfectly clear when's the right time to get in or out. And you're never going to know the answer to this question, John Penn. It will never come that you'll know that this is the time to buy. And that's part of the reason why we keep some exposure to all asset classes at a minimum. And then when we see that on an FVMR basis, they're looking interesting, then we move to that allocation. Now, you can say that because gold is, heavier in our portfolio, that right now we are more buyers on gold. So that may give you some clue as to what we're thinking. Gal said, do you plan to reduce the 25% allocation in the EU stock market soon? Well, the answer to that is that we've recently, done our rebalance and have, and now we're sitting on our positions and waiting. We wait until 3 months, and our next rebalance, I think Alex will update me on this. Let me just double check. But I'll give you information on our next rebalance in just a bit. But what I would say is that our next rebalance is when we'll consider our EU allocation. Now, just to go back to Supercorn asked the question about ASEAN. Let's just go back to that question for a moment. Actually, ASEAN is part of the Asia Pacific ex-Japan, ex-China fund that we now have in the portfolio. The fund's currently overweight Indonesia and Malaysia in ASEAN and also in Korea. So that builds our exposure across Asia, but that also means part of our ASEAN exposure. Let's see what other questions. Make sure you ask your questions. I'll be sure to answer them. Let's say most update data seems that the Fed will not lower rates while all asset and stocks seem very volatile. Follow data show opposite to analyze forecasts. My feeling, I still maintain my same position that I think the Fed is eventually going to have to come down substantially on its rates. The economy's held up stronger, the market's held up stronger, but I'm off by some timing, but I still have that opinion for right now. How do you view EU after the rate cut? Yeah, I mean, EU is in some trouble for sure. I mean, there's some difficulty. You could argue that they're trying to get ahead by lowering interest rates right now before the US does, let's say. But I guess my concern about the rate cut in the EU is not so high. It's not a big issue that I'm looking at. I think the elections that are happening and I think what we're going to see is a pretty big shift happening not only in Europe, but also in America towards different policies than the current policies that we see. Let me continue on with the presentation, but make sure to ask your questions. I love to get questions. I know we have about 180 people on this right now, so feel free to ask any questions that you have. I'm going to go back to the presentation, and we're going to talk about all-weather strategy next. And just for everybody's note, we're going to be doing our next rebalancing in early September. So it's going to be a while from now. So here's our current weights, 65% in equity and 25% in gold. And again, we're not making any changes till September, so you could say we're definitely positive on gold. Now, since inception, the all-weather strategy was up 44.9%, and that's 20% above a 60-40 portfolio. And in May, the strategy was up 1.6, which was 1.1% below the 60-40. So we didn't perform that well. Our 25% target allocation to develop Europe did okay, while 25% allocations to APAC, ex-Japan, China, and gold dragged on the performance, as well as an underweighting in the U.S. when the U.S. was rocking. But still, we were able to produce a positive return. Let's look at Alpha Focus for a moment. That gained 1.3%. Right now, we've pulled back and we're down to 68% on equity. And therefore, we've positioned 13% in bonds and 19% in gold. So again, going back to the gold question, we're pretty bullish on gold to have that kind of weighting in gold. So let's look at all-weather Alpha Focus. Since inception, the strategy has been flat, and it's about 6.1% above a 60-40 portfolio. And about 0.9% below the world equity, but with a lot less volatility. As you can see right here, there's a lot of volatility right here in world equity that we didn't participate in, and that's because of our asset class dispersion. Now in May, the strategy was up 1.3, which was 1.5% below the 60-40, and our 17% tilt to infrastructure outperformed, but our 17% tilt to healthcare underperformed. Our tilts to gold and bonds also dragged on performance as well. So it was still positive, but it was rough as far as relative performance. And finally, inflation guard, which is incredible, 1.2% up. Remember, we're only 25% equity right now and 60% bonds. So this is a defensive portfolio as well. We've got 10% in gold. So since inception, the strategy was up about 6.8% and 7.5% above the 40-60 portfolio. It's experienced less volatility too. You can see the red line is much less volatile than the blue line. And here, the strategy was up 1.2%, which was 1.1% below the 40-60. Our 5% target allocation of commodities did okay, but it was offset by the poor performance of world energy. TIPS and gold both outperformed global bonds. What you can see from this is that for all of our strategies, we've underperformed in May. It wasn't a great month for performance, but because the markets were relatively strong, we still had some positive performance. Before I go into some special research where we've been looking into gold in a little bit more detail, let me come back and look for any questions that we may have. All right. Well, I don't see any, but make sure we've got 188 people on here. Make sure to do your part and ask questions because that's why I'm here. I would love to answer any questions that you have. Feel free to. Mom's in the kitchen right now having a nice lunch. She just finished riding her bicycle. She has a stationary bicycle. She rides it for 1 hour before lunch while she listens to podcasts, which is pretty impressive when you consider that she's 86 years old. All right. So, all right. One question that came in from John Pent says, is now the right time to invest more in global bonds? Yeah, I mean, as you can see, we've turned defensive. We have reduced our U.S. equity exposure. That's hurting us as the U.S. is rising, but we're doing that because we have turned defensive. So in theory, global bonds would do relatively well if we are correct and the U.S. market starts to come down. But I would say that you have to be careful about how you balance these things and don't just chase because, let's say, it's doing well now or doing poorly, getting out. Yes, Gout, the research on gold, I think, is going to be fun. We've got about 200 people on the line, so I'm looking forward for any questions about gold. And Peter Parker says, what's your opinion about gold? Well, that is what I'm going to talk to you next because I've done some stuff on gold, which I'm going to share with you. Let me see. Next question is Poonwadi says, how much money customers can start investing in your plan? I don't know the exact answer to that. So you want to check on the website or check with your advisor. Some of the strategies are a little bit lower, but I don't have the answer to that right offhand. But I think we'll take a look. I think we have a minimum for, I think, one of the funds, but I can't remember exactly the amount. So that's going to be best answered by going to the website or an advisor, or if my team can find out, I'll let you know. All right, let's go into the next thing, and that is the case for gold. So gold is money and it's a store of value, and adding gold to a portfolio reduces volatility and drawdowns. We've seen many all-time highs in 2024, Are there more to come? Well, that's part of what we're going to be answering here. Gold's not an investment, and it doesn't produce any yield. But gold has two significant shortcomings, being neither of much use nor procreative, meaning it's procreating, meaning it's causing more, like dividends as an example. Or gold can serve as a safe haven during times of uncertainty. Basically, gold is a way of going long on fear, and it's been a pretty good way of going long on fear from time to time. However, it's worth noting that gold doesn't always go up when stocks fall. Now, gold has been a store of value for thousands of years. History shows it's been valuable to humans for at least 5,000 years. In fact, pieces of natural gold have been found in the Paleolithic caves from 40,000 BC. That's 42,024 years ago. The first gold coins were possibly minted in the kingdom of Lydia, which is modern-day Turkey, in about 700 to 550 BC. So from early on, gold has been used as money. Fed Chairman Alan Greenspan said, "There's something about gold. I've thought about this for a number of years, and I reached a blank. It's almost as though, technically speaking, the ability of having a stable price has great value." Let's assume that gold is money and has a stable value that doesn't change. Then we could think of gold returns as a form of real return. Let's take a look at U.S. stocks. In the past 10 years, the S&P 500 was up 71% in terms of dollars. Now, think about this. When we say in terms of dollars, it's the typical way that we look at the S&P 500. It's just quoted in dollars. But what if we were to put it in gold terms? So in the past 10 years, the S&P was up 171 in dollar terms, but only 44% in gold terms, meaning gold rose quite a bit or was flat, but the dollar fell. Now, in the past 5 years, the S&P was up 92% in dollar terms, but only 6% in terms of gold. So part of what you're seeing here is a weakening dollar. In the past 3 years, S&P was up 26% in terms of dollars and only 2% in terms of gold. So for the past 5 years, the S&P, let's bring all three of those together, is hardly up if we measure it in terms of gold. So we can say that gold is a stable asset, or relatively stable asset, and it's definitely not falling in value like US dollar. So if we look at it that way, the S&P actually isn't as strong as you'd think if we look at it in gold terms. So now let's talk about the benefits of adding gold to your portfolio. Gold's highly liquid, it bears no credit risk, and can work as a true diversifier to your portfolio. Gold can also work as a hedge against inflation or in times of uncertainty. Many times when equity markets have fallen significantly, gold has risen or at least remained stable. We think it is likely that gold could continue to be a store of value and be uncorrelated to equity. So let's take a look at the major asset classes' 3-year rolling correlation to world equity. Now remember that greater than 70 or minus 70 is high correlation, and 50 to 70 is moderate correlation, and about 20 is uncorrelated, if we say between 20 and minus 20. A strong negative correlation helps you to hedge. A minus 100 correlation means the two assets perfectly offset each other. And uncorrelated assets help us reduce risk, as the two assets have no predictive relationship. Other factors then drive its return. So let's take a look first at bonds. What we can see is bonds. So what we've done is we've looked at bonds relative to equity, world equity, not S&P 500, but world equity. And from this, we can see that bonds are moderately negative correlated with world equity. Here's gold. and we can see that gold is basically closer to the midline, meaning uncorrelated. We do have some times of negative correlation, and we do have some times of positive correlation, but overall, you could say it's an uncorrelated asset in relation to world equity, and therefore it has benefit in the portfolio. So here we can see commodities, and the problem with commodities is at times commodities can be highly correlated with the world equity market. Now that correlation's come down. You can see it's getting close to 20, which would be considered getting close to uncorrelated. But that's just at a period of time. When if you were to invest in commodities, you have to expect that it could go back up again. We don't know when, but it could. And this higher level of correlation tells us that commodities is not a great diversifier. In fact, it behaves a lot like equity. Now, the stock market in the US has been going up and up and up, and commodities have been coming down a bit. And so commodities haven't been performing that well. Now here we created 3 portfolios to see the impact of gold in a stock portfolio. And from this, we looked at the performance from January of 1972 until May of 2024. We use the US stock market for the equity portion of the portfolio. And we compared 3 different portfolios. One was 100% stocks. Then it was 90% stocks, 10% gold, and then 75% stocks, 25% gold. Those were the 3 portfolios. Now, this is a logarithmic scale that I'm showing you here. And so what you're going to see is that those lines look very similar. But if we look at it from a drawdown perspective, we can see higher gold allocations generally means lower drawdowns. So to look at this, you can see if you were 75% equity, 25% gold, that's this point right here. You can see instead of coming down to there, let's say to 43 as an example, the portfolio only came down to about 32. So you could say that that difference was about roughly 10%. And that's part of the reason why we invest in gold in the portfolios, because we know that when the allocation's high, that gold does help. Now, let's look at another case of when the allocation is 10% to gold. Well, what you're going to see is that if it's 100% stocks, let's say here, it's going to be there. If it's 90% stocks, 10% gold, in this particular period, it's going to be there. And if it's 25% gold, it's going to be there. So this gives you a picture of just even in this case. Now, you're not going to get a repeating period. It's never going to repeat perfectly. So times have changed. But the one thing you can say is that even a small amount of gold at 10% can reduce that drawdown just a bit. So during periods of larger drawdowns or drawdowns larger than 20%, higher gold allocations have performed better. So only in one instance did this not hold true, and that's the point about investing in markets, is that you can never, ever see something repeating all the time, because if something does repeat all the time, what's going to happen is that people are going to invest in that and they're going to take away that. So gold has historically made a better portfolio. Here we see 100% equity. Here we see 75% equity, 25% gold, and then we have in the middle. Let's look at this in detail. The gold even increased the return slightly over this period. We can see the equity was 10.62, but with gold, it became 10.79 and 10.82. Now, I have to tell you, this is rare because in the past, gold didn't perform that well, but during this period, it did. And again, the past is no guarantee of the future. So all we can do is look at what has happened in the past to understand it. Now, you can also see that it reduced the volatility. High volatility of 15.74 if you're 100% equity, went down to 14.3, and then 12.9 by adding more and more gold. But most importantly, it reduces the painful drawdowns. The drawdowns went from 50.89 down to 45.41 and 36.61. And the hope is that if you end up, let's just say that we're not always 25% in gold. Let's just say that we have a 40% drawdown because we're somewhere in the middle of 10% gold and 25% gold. So let's say that we have a 40% drawdown right here. So it could be 51, it could be 45, but let's say that realistically, forget about 45, forget about 36. Let's say that we are at a 40% drawdown. The difference between that 50.89 is 11 percentage points, and that can make a lot of difference for an investor. Sometimes when you see the market go down by 51%, you feel terrified. But if you know that you're coming down by a little bit less, it makes you feel a bit better. Now, one thing that makes us different in our allocations is that we're willing to put more gold in our strategies. What I wanted to do is show you that 98% of advisors recommended less than 5% gold. We can see the percentage of investment advisors, 0, less than 1, say 71% say less than 1% gold. 27% say 1 to 5% gold. That's incredible. There's, almost no advisors advising that you put a heavyweight in gold. But we, in our FEMR strategy, sometimes will get a pretty heavyweight in gold, up to 25%. I would say that's very heavyweight. So at times we can go as high as 25% in our gold, depending on our strategy. Now, why not just hold cash to protect the downside? You're like, Andrew, I don't need to hold gold. I'll just hold cash. Well, holding cash in your portfolio also reduces the portfolio's volatility for sure. But gold can protect you from devaluing currencies. And gold prices can also go up in times of uncertainty and conflict. So gold is like holding safe cash and has some potential other benefits too, which adds more benefits to your portfolio. So the answer to the question, why don't we just hold more cash, is right here. And if we look at all currencies, the major currencies, we can see that they've all weakened greater than 10% relative to gold year to date. Gold's just been on a tremendous run. Typically, a stronger dollar means a lower gold price in US dollars and vice versa. So now let's look at the all-time highs. Let's have a bit of fun again. If gold is constant, we can assume that money printing should lead to a higher gold price in that currency. So in other words, if gold is constant, but the US dollar, the supply of US dollars continues to rise because they print money, it means that the US dollar is going to fall in value relative to gold. So let's use that assumption to come up with a price range for the gold price in US dollars. The US money supply has become about 15 times larger over the years. But gold price in US dollars is only up 10 times. So is gold undervalued? Well, gold price could be fairly valued or surpass 3,100 if you looked at it this way. In the past decade, US M2 is up by 88%. But when was gold fairly valued relative to M2? We can see at this point that gold price had caught up with M2, and that was about 2010 or so, or 2011. And then it was undervalued when it was down to 1,283. Now, adding 88% to those numbers, we get a range of between 2,400 to 3,100 for gold. The median gold price is then about 2763. Now, I'm not forecasting it or making a prediction, but I'm just using some tool to try to think about how we could value it. So the lower bound is similar to where the gold price currently is, right? The lower bound we said is 2410. And we can see that's roughly where gold is. So we don't base our investment decisions on price targets, but let's look at a few reasons why we think gold is relatively attractive currently. Central banks have loaded up on gold, maybe switching from US dollars. Here we can see that there has been a fall in the holdings. The red arrow that you see shows the fall in the holdings of US government bonds held by foreign central banks. And we can see central bank holdings of gold is starting to rise, but it's nowhere, of course, near where it was in the old days. Now, was it Russia's invasion of Ukraine in February 2002 that got central banks to load up on gold? Well, we can see a huge increase in 2022 and 2023 of gold demand from central banks and other institutions. This is metric tons. And what we can see is that the total demand from central banks and other institutions was almost as great as in the preceding 5 years. So we expect central bank demand to remain strong. Now, gold is typically a safe haven in times of geopolitical tension and financial turmoil. Rising government debt in many economies like the US can raise concerns about credit quality and stimulate the gold price. And gold recently has strong momentum. Was looking at a 50-day and a 200-day moving average to try to understand. And of course, we've seen that gold has broken out of both of these. Now it's come back in line with that 50-day moving average. So based on previously mentioned reasons and sticky inflation, gold has gained momentum. We think it can continue, and we also like to keep gold as insurance. We've raised our target allocations to gold in all of our strategies. So let me summarize the case for gold. Gold is money and a store of value and has historically reduced the drawdowns of a portfolio. And all currencies have weakened greater than 10% against gold in the year to date, 2024. We're different than other allocators because we're willing to put more into our gold strategies. And in our latest revision, we've raised our target allocations to gold in all strategies. So before we get into Q&A, hopefully you found that interesting and you've got questions, which I'm going to come back and try to answer. But before we get into that, let me remind you that we have Valuation Masterclass Bootcamp 16 starting on July 8th. And we help finance professionals become valuation experts in months rather than years. And we have many previous attendees coming from FINNOMENA. Here are some of them. Chachada she's an advisor at FINNOMENA and was one of our students. Tosaporn, also an advisor and one of our students. Chacon, also a student. Jutamas is a customer of FINNOMENA who joined the boot camp. And Bunsim also joined from FINNOMENA. Pong Sakon also joined. In the Valuation Masterclass Bootcamp, you get a 6-week guided intensive online valuation bootcamp. There's daily live sessions, team support, and progress tracking. And then you end up writing a full professional valuation report. So you'll get an extra $100 off. That means you're saving $800 and you're going to get some great bonuses. All you have to do is use the coupon code FINNOMENA. You can go to valuationmasterclass.com/bootcamp to learn more or just scan that QR code. So it's time for questions. Let me switch back and look at any questions that we may have. So let's see. Yeah, Grid Optimized said, do you interested in the Bitcoin ETF? I think it's interesting. You know, it's just come out. We're going to let it come out and get adjusted a little bit to it. We're going to study it. And if we see that it can add value to our portfolio, then we'll consider it. In fact, I'll make a mention right now to Alex on this call who works with me and we're partners along with Swansak. Alex, you should take a note because we do need to look at the Bitcoin ETF coming out of, I believe it's One Asset Management. All right. Gal says, what do you think would be the biggest risks of our portfolio, AWS, in the upcoming quarter? Well, part of the thing that I'm trying to do is diversify across asset classes. And the result of that is that I'm trying to reduce risk. But I would say that it's what's biggest concern to me is that we're underweight the U.S. market. And if the U.S. market starts to really rise, we're going to underperform for sure. And we've already seen some of that. So I think that's, to me, the biggest risk with the strategy right now. And I would say that is the biggest one. All right. Pia Watt says, what are your views about Thai equities? Any catalyst? You know, I've been looking at the Thai market quite a bit and thinking about it. And my opinion is basically one of the big things that Thailand is doing is Thailand is putting so much ESG and sustainability pressures on listed companies that it's starting to kill their profitability. And I don't think that government bureaucrats realize how much damage they're doing to Thai companies that are listed in the market. And people aren't speaking up and trying to stop them from putting in this much pressure from an ESG and sustainability perspective. So that, to me, is one of the things that's a heavy weight on the Thai market. And it is only going to get worse as technocrats and bureaucrats keep coming up with new ways of putting ESG type of regulations on companies. As long as you do that, you're going to see more and more pressure coming onto the companies. Now, it's not the only reason why profitability is down, but it is, I believe, a significant one. Hopefully that answers the question, Pia Watt. All right. Make sure to ask any questions that you have. Pravit says, can you share your point of view in the situation in China's central bank halts buying gold? Well, it's very hard to predict what's happening in China. I would say that the Chinese government is really stuck because first, they have a collapsing property market. They have an equity market that Chinese people never really invested in because they didn't trust it. And if the property market continues to fall, it's going to start really hurting banks because property is the main collateral for banks. So I believe that what we're going to see is the central bank trying to control things and trying to support banks and possibly support the property market. In doing so, their objective is just to prevent a collapse. That's my view right now of what's going on. And it's probably more than just buying gold. There's more to it. All right, let's see. Peach says, how is the upcoming election in Europe affecting the price of gold? Well, I think that what we've had in Europe for a long time is what we would call neoliberal or liberal policies going on for a long time, like open borders, and also the war is what would be considered a neoliberal policy. And basically, and immigration as another one. And I would say that this swing to the right is only natural. It happens all the time in politics. And I would say that it could be that we're maybe 5 years that we'll see more conservative or more right-wing leaders in Europe. And I think this could be some foretelling of what's going to happen in the U.S. election in November. And that U.S. election, basically we had kind of a liberal and neoliberal leaders in the U.S. And it's quite possible that Trump could win or gain back a pretty significant chunk of votes if America follows Europe's lead. Sati Mehdi says, I like the reason to hold more gold in the port. Are we going to hold at least 25% in the long term? Well, 25% is a huge amount of gold to hold in a portfolio. I would never say hold 25% for the long term. Remember, gold doesn't produce any dividend. It's not like a company where there's management working hard on your behalf. It's just you're hoping that it rises in value. So what I would say is that if we were just looking at a portfolio for someone, what I would say is that that portfolio basically should have maybe 5%, maybe 10% gold, but to have 25% is pretty extreme. The reason why we have 25% is because, remember, we use FVMR, fundamentals, valuation, momentum, and risk. And those four factors, if they're attractive for gold, we could overweight up to 25%. But to answer your question, I don't think that a 25% kind of permanent weighting in gold is a good idea for the long term. All right. Keep your questions coming. Pichit, you're welcome. All right. Next question comes from Pitt. What is your thought about U.S. market, especially AI, that's making all-time highs? Any risk or external factors that may make market collapse? The best sign of market collapse is market bubble. And I wouldn't say that the U.S. market as a whole is in a bubble, because if you strip out the top 5 or 10 companies, you'll see that the overall market's not expensive. So from my perspective, the U.S. is not in a bubble. Are the tech stocks or the top 5 to 10 companies like NVIDIA, as an example, in a bubble? I think it's getting there. You know, you can argue, compared to the .com boom and bust, that these internet companies are much more profitable. But I still think that whenever you see extreme rises in price, that's the best sign that we're heading into a correction. And so that's the thing that my FVMR model is telling me, and it's part of the reason why we're underweighting. By the way, I remember listening to Peter Schiff's podcast a while ago, and he said something that he articulated very well. He says, most people think that a recession is the problem and a boom is the solution. He said, that's wrong. The boom is the problem and the recession is the solution. What does that mean? In boom times, everybody's building businesses and bringing in a lot of additional supply into a market. And then investors are pumping up prices for those companies. But that is eventually becomes malinvestment over the optimistic investment. And the only way that can be corrected is by a market crash. What happens in a market crash? The weak companies can't get funding and they get hurt, and they may even exit the market. And the weak investors pull out and lose money, at the end. And the point is that once the down cycle of an economy or a market is done, then most of that has been cleaned out. All right. Well, there's 248 people on this call, and I appreciate that on a Monday. I'm just getting ready for Valuation Masterclass Bootcamp tonight. And also, I've got some other stuff I'm doing today and tomorrow. But I hope that everybody learned something. And if you have any question, make sure to reach out anytime, as well as talk to your advisors at Phenomena, and go to the website of Phenomena for any questions that you may have. I want to thank everybody for joining and all the great questions. I hope that you learned something from that. And most importantly, remember, we're here to build wealth over the long term. I'll see you next month.